So last week was a pretty big week in the stock market. We saw what was beginning to look like a rather significant sell-off, mostly because of renewed COVID fears. But as always with this market, that fear and that panic was completely wiped away after a few days. That being said, however, it still created a small window of opportunity for option sellers. So specifically, I'm referring to implied volatility, right? During those few days where people actually were panicking about COVID, implied volatility across the market spiked pretty significantly. If you looked at the VIX, for example, and the VIX shows you the implied volatility for the S&P 500, the VIX spiked by over 25%. That's a huge amount. And in short, what that all means is option prices across the board, across the market, also experienced a short-term spike as well. So as an option seller like myself, that's going to be a very good opportunity to go in and start selling those expensive options. So in this video, I'm going to first show you 2 trades I made last week that took advantage of that short-term situation. And then also I'm going to show you a few trades I made on the earnings announcements that came out last week as well. Right, so that was the second major thing that made last week rather significant. We had a lot of big companies like Twitter, Snapchat, Netflix, etc. coming out with their earnings figures. And so I placed trades specifically on Snapchat, on Twitter, and on CLF, which is Cleveland Cliffs Incorporated. They're involved in the production of iron and steel. And I'm going to walk you through those trades and my thought process behind them, and then how I manage those trades afterward. Now, before we fully dive in here, in case this is the first video of mine you've come across, my name is Scott Reese, and this channel is all about helping you to actually learn how to trade, invest, and master your finances so you can then apply that knowledge in the real world and multiply your money. There's no annoying hype on this channel, no cash, no flash, no Lambos, none of that BS, none of that garbage. I'm all about offering purely educational content and some real advice as well. And lastly, I do want to let you know that you can also find me on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. And so with all that being said, let's jump on over to my computer now and we'll get things started. Okay, so very quickly here, I wanted to first show you the VIX futures contracts. So let me zoom in a bit. And this was the spike in implied volatility I was referring to. So again, the VIX here shows you the implied volatility for the S&P 500, which represents most of the market. And basically when these spikes occur, which you can see happened this past week, and many times in the past, you will also see a spike in option prices, right? And that's because implied volatility is used to price option contracts. So the full picture here is when people get scared, when the market sells off, you will almost always see a very significant expansion of implied volatility and therefore an expansion of option prices, which makes for a great opportunity for option sellers to step in and start selling those overpriced, very expensive options. And the reason why I say overpriced is because most of the time when you get a spike in fear like this, what happens right after or very soon after? It all goes away, especially in this market. So you can see already with this most recent spike in implied volatility, the very next day after the VIX reached its peak, it came right back down, which of course makes options a lot cheaper. And then that allows option sellers to buy back those contracts for a much lower price and make the difference as their profit, right? Sell options up here when options are very expensive, then buy them back down here when they become a lot cheaper. And that allows you to bag some very quick profits. So now let's come over to the XLE chart. This is an ETF that tracks the energy sector. And so let's zoom in again. And along with the general market, this ETF did experience a pretty significant sell-off as well. And when I saw this happening, I noticed that XLE came all the way down and touched this pretty significant support level, which I've drawn here in red, right? So you can see many times in the past, this ETF came down to this price or very close to it, and it bounced right off. So once I saw XLE come down and hit the support level and then back off of it, that gave me a pretty good indication that the support level was going to once again hold. And of course, moreover, down here you can see a chart of the implied volatility for XLE, and look what happened. During that sell-off when everybody was scared, we saw a spike in implied volatility and therefore a spike in the option prices on XLE. So this combined with the fact that we also hit a major support level convinced me to step in and start selling naked put options. And ultimately this was a great trade. The support level did hold and we got a nice bounce after that. And combined with this bounce, we got a contraction in implied volatility. So in this case, I got the directional move correct. and also took advantage of that natural decrease in option prices when implied volatility comes back down. And those two things together allow me to book my profits just 1-2 days afterwards. Right? It was on this day at the high where the prices of the options I initially sold on this day got cut in half. So ultimately, I bought those puts back for half price and made a nice profit on that. Next, let's go to IWM. This is an ETF that tracks the Russell 2000 index, and we had a very similar story. Just like XLE, just like the NASDAQ or the S&P 500, this ETF also experienced a pretty major sell-off this past week, and look where it ended up. At the very low of the sell-off, it also hit a pretty significant support level. So looking at the past, you can see many times where IWM came down to this price and bounced off this price level, which is around $208 per share. And same thing, along with that, we got a very nice spike in implied volatility, a spike in the option prices on IWM. Now, because this is a pretty expensive product at over $200 per share, I did not sell any naked options, but I did sell a $10 wide put credit spread. So specifically, I sold, let's go to the trade tab here, and I was in the August expiration cycle for both of these trades. I sold the 210 strike put option and then bought the 200 strike put option. That was my put credit spread position, and just like XLE, right after IWM hit its major support level, it bounced right off it. So I was also able to take this position off for a full profit. And also I did forget to mention, let's go back to XLE real quick. I forgot to mention the exact strike of the put options I sold. So specifically, I sold 2 contracts of the 46 strike put option. And I sold these contracts for about $200 each. And now you can see with their prices currently at around $80, they have obviously come way, way down in price. So these 2 trades really are textbook trades in terms of waiting for a spike in implied volatility and using a little bit of technical analysis to figure out your directional assumption and your strikes, and simply taking advantage of short-term fear or panic in the market, because most of the time, fear and panic is short-lived. It's only in rare cases where that panic can really materialize into a significant sell-off, and that's where most people will get hurt, but like I said, those are much more rare events. And now let's talk about earnings trades. So we'll come over to the CLF charts first. Again, this is Cleveland-Cliffs Incorporated. They're involved in the production of iron and steel. Now, I do already have a video that goes into a very in-depth discussion about how earnings trades work, but simply stated, they function in a very similar way as with the XLE and IWM trades I just showed you. So the vast majority of the time when earnings announcements come out, that's what these dots on the chart represent. So the majority of the time, right before these earnings announcements, you will see a spike in implied volatility, a spike in option prices. So in this case, I waited just a few minutes before the market closed, just a few minutes before this company released all their earnings figures, and I sold a bullish skewed strangle. So let's go to the trade tab real quick, and you can see I sold the 19.5 strike put option, and then also the 27 strike call option, and I sold 2 contracts each. And the reason why I skewed this strangle to be bullish is because I do think this upward trend is going to continue. That is just my directional assumption. Of course, I could be wrong. But as you can see here with the support level I drew, or this trend line, there were many, many times in the past where CLF came down and hit this trend line and bounced right off it. Now, recently you can see it cut right through it. And so this was a bit concerning to me. But as you can see, at least so far, CLF has recovered and is now back within this channel here. So as of right now, I am currently directionally correct on this trade. So far, so good. And also coming back down here, look what happened to implied volatility once those earnings figures came out. There was a lot of uncertainty about how this company was performing, but once those numbers come out and everybody knows exactly how CLF did this past quarter, boom, no more uncertainty, no more fear. And I would say mostly because of this pretty huge contraction in implied volatility from 90% all the way down to 68%. That's why, as of right now, you can see I'm up on this trade by over $100. So I still have a little ways to go before I hit my profit target, but I've also only had this trade on for a couple days. So I think this really demonstrates the power of selling options when implied volatility is high and taking advantage of a very likely contraction in the near future. Next up, let's come back to the charts and we'll look at my Twitter earnings trade, which already came off the day after I placed the trade. And again, in this case, it was almost entirely having to do with the fact that implied volatility got absolutely crushed. right? Just like CLF, right before these earnings came out, we had a buildup of uncertainty, a buildup of implied volatility, and then once these figures came out, boom, no more uncertainty. So the prices of the options I sold got absolutely crushed. And combined with this, the stock really did not move at all. Twitter basically finished up by about $2 the day after the earnings figures were released, only a 3% increase in price, and well within the expected range. Right, I believe the expected move, either to the upside or the downside, was about $6 or $7. That's what was being priced into the Twitter option contracts at the time. But ultimately, this is a textbook definition of what a great earnings trade looks like. A big buildup in implied volatility beforehand, and then once the figures come out, the stock really does not move all that much, or at least it moves within the expected range. And so specifically for this trade, let's come to the trade tab. Again, I was in the August expiration cycle. I sold the 80 strike call option and then also the 62 strike put option. And this at the time was a completely directionally neutral strangle, meaning the delta on my put option was exactly the same as the delta on my call option. They were both 25. So unlike my CLF strangle, which was a bullish skewed strangle, this was completely directionless. I didn't care whether Twitter moved up or down. All I cared about was that it moved up or down within the expected amount, which again was about plus or minus $6 or $7. And because Twitter ended up only moving up by $2, that's why the implied volatility on these contracts collapsed by so much. And so like I said, literally the day after these figures came out, the price of the strangle I sold got cut in half. Right? I sold that strangle for about $360 in credit, and then bought those contracts back for a debit of about $180, half price. So I was very, very happy with this trade. And then finally here, let's look at Snapchat, which was the one bad earnings trade I've made so far. So again, it was a very similar setup to the Twitter trade. As you can see here, I did do a little bit of technical analysis. I was basically saying that this line down here was going to act as a support level, because as you can see, many times in the past, it did act as support. And then up here, this was overhead resistance. Now for this trade, I sold the 72 strike call option, also in the August expiration cycle, which was right here. And as you can see, it's now super far in the money. And then I also sold the 57 strike put option. So at the time, this also was a completely directionless strangle. The delta on the put was the same as the delta on the call. The expected move for Snapchat was either up or down by about $7. And unfortunately, as you can see here, it moved up by $15, 2 times the expected move. And that's because somehow Snapchat just totally blew away their earnings expectations, right? You can see down here, their estimated earnings per share were negative 18 cents per share, but in reality, they came out with positive 10 cents per share. So as a result, boom, stock explodes by about 24%. And ultimately, when it comes to earnings trades specifically, and earning trades that go badly like this, where the stock actually moves well beyond the expected move and just blows away all my technical analysis and just totally changes the game, I will typically just take the trade off for a loss, right? Based on their actual earnings figures, there's no way I want to be short this stock at a price of $72 per share, where my call strike was. So I did have to buy that strangle back for a loss, but it wasn't nearly as bad as it could have been because, as you can see down here, implied volatility did contract. So I did get the directional move very, very wrong, but the losses I faced on my call option were partially offset by the contraction in implied volatility. So in the end, I bought those contracts back and took a pretty reasonable loss of just a few $100, not a big deal. So this was the one bad trade I made this past week, but the losses on this one were more than offset by the profits in XLE, IWM, Twitter, and CLF so far. So overall, definitely a very good week last week, because as always in the world of option selling, implied volatility really is your best friend. And so with that being said, that's going to do it for today's video. I hope you enjoyed it, and please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.